Welcome to The Explainer. Today, we're unpacking a truly fascinating financial release from So Young International. We're looking at their Q1 2026 earnings report. And you guys, right at the heart of this data is just a massive, compelling contradiction. It's a classic business story, really. Rapid scale colliding head-on with heavy investment. We're calling it the growth versus cost paradox. So if you want to understand exactly how a digital platform pivots into a heavy asset physical network, well, you're in the right place. Let's get into it.
Okay, let's dive right into this with a number that's definitely going to grab your attention, 185.8%. That is the unbelievable year-over-year revenue growth in So Young's aesthetic treatment services. I mean, for any business, seeing nearly triple-digit growth in a single vertical is a massive win, right? And it serves as the absolute perfect hook to understand the sheer momentum this company is riding right now.
To figure out the surprising costs hiding beneath all that growth, here's our roadmap for today. First, explosive Q1 revenue growth. Second, the widening profit paradox. Third, expanding brick-and-mortar centers. Fourth, shifts in revenue streams. And finally, number 5, the dual-engine future.
Starting off with Section 1, explosive Q1 revenue growth, top-line triumphs.
When you look at the raw revenue just pouring in the door, Q1 was an undeniably strong quarter for So Young. Comparing the first quarter of last year to this year, total revenues surged from 297.3 million RMB to 432.8 million RMB. That's a super healthy 45.6% jump across the entire business. So what's the big takeaway here? Well, we are looking at a company in a state of rapid, almost dizzying acceleration, literally blowing past its own high-end guidance for the quarter. And listen, this top-line revenue growth, it isn't just some clever accounting trick. It's backed by massive, tangible user volume. Just look at these operational highlights. Verified treatment visits shot up from 54,400 to 148,000. Total treatments performed actually surpassed 325,000. And their active user base, which they define as someone visiting a branded aesthetic center at least once in the last 12 months, well, that expanded rapidly from around 75,000 to over 213,000. They are quite literally tripling their core consumer engagement metrics across the board. Moving on to Section 2, the widening profit paradox. The plot twist.
Now, what's really interesting here is where the story takes a sharp turn. Check out this glaring discrepancy. Despite total revenues jumping by over 45%, the net loss actually widened. Back in Q1 2025, the net loss attributable to So Young was 33.1 million RMB. But in Q1 2026, even with all those record revenues we just talked about, the net loss grew to 49.2 million RMB. Which leads us directly to the million-dollar or, multi-million RMB question. Why on earth are losses growing during a period of record-breaking revenues? How does a company triple its user base, triple its treatment volume, yet end up losing more money than they did the year before? Let's figure that out in Section 3, expanding brick-and-mortar centers. Solving the mystery. To actually solve this mystery, we've got to look under the hood at their strategy, and the magic number here is 54. As of March 31st, 2026, So Young is no longer just an online platform. Nope, they have built a heavy asset anchor of 54 fully operational, branded aesthetic centers across 16 major Chinese cities. We're talking massive markets like Beijing, Shanghai, Guangzhou, and Shenzhen, and 53 of those directly operated by the company. Now, as you can probably guess, running physical clinics requires massive overhead, and that is exactly what's eating into the profits. Because of this rapid brick-and-mortar expansion, their total cost of revenues rose by 65.8% to 251 million RMB. If you isolate just the cost of those aesthetic treatment services, it surged by 156.4%. But wait, it doesn't stop there. Sales and marketing jumped 33.7%, largely due to center payroll and branding, and general and administrative expenses up 42.5%. Long story short, scaling in the real world is incredibly expensive. And this brilliantly illustrates the long game they're playing. If you look at the timeline of these centers by phase, you see that physical clinics take real time to mature. Check out the ramp-up phase. Centers open for just 2 months average only about 2 million RMB in revenue. But as they hit that maturity phase, so over 12 months old, that average revenue per center absolutely surges to 7.5 million RMB. So yes, the heavy initial costs are painful now, but they're paving the way for major revenue down the line. So while the overarching corporate entity showed a widened net loss, the individual unit economics are actually incredibly promising.
Out of those 54 centers, 41 achieved center-level profitability this quarter. On top of that, 48 generated positive operating cash flow. So on a localized level, the underlying physical foundation they're building is actually proving to be very successful. Which brings us to Section 4, Shifts in Revenue Streams, the business pivot. So the crucial point is that this physical expansion represents a fundamental transformation in So-Young's actual DNA. Direct treatments are now the undisputed core of this business. Just looking at the revenue breakdown for Q1, aesthetic treatment services brought in 282.4 million RMB, completely dwarfing their legacy information and reservation services, which only brought in 80.3 million RMB. They aren't just the middleman connecting you to a doctor anymore, they are the doctor's office.
And this contrast is stark, and it's totally intentional. While aesthetic treatment revenues are absolutely booming at a 185.8% growth rate, their information and reservation services shrank by 34.0%. Why is that? Well, basically, fewer medical providers are subscribing to So-Young's platform. As So-Young opens its own clinics, it naturally transitions from being a neutral marketing platform for third-party clinics to being their direct physical competitor.
But, to survive a massive pivot like that, you need immense customer loyalty. And that is exactly where So-Young's core membership comes in. They grew the space by over 11,700 members just in Q1. And here's why this matters so much. This core group contributed over 80% of those massive aesthetic treatment revenues, and they boast a quarterly repurchase rate of nearly 80%. This highly engaged, fiercely loyal user base, that's the secret weapon sustaining their risky shift into brick and mortar. Let's wrap things up in Section 5, the dual-engine future, resolution and outlook. So what's the ultimate strategic vision here, and what can we expect next? Co-founder and CEO Xing Jin summed up their philosophy by pointing to their dual-engine strategy. Basically, one engine is the online platform, which provides the scale and digital reach. The other engine is the offline network, providing standardized, highly efficient medical delivery. He notes they plan to expand this physical network at a measured pace, which really signals they know they have to balance growth with those heavy operating costs we talked about earlier. Let's move to and see how this builds into the big picture. When you look at the official financial and operational highlights, you can see management's optimism is thoroughly grounded in these record-high segment revenues and the rapid verification of their physical store model. They are systematically putting all the pieces in place to dominate the entire medical aesthetic value chain in China. And looking right around the corner, they fully expect this momentum to hold strong. For Q2 2026, their guidance projects aesthetic treatment revenues to land somewhere between 307 and 317 million RMB. That would represent another huge year-over-year increase of between 112 and 119%. Clearly, the top-line revenue train isn't slowing down anytime soon. But as we've learned today, top-line revenue isn't the whole story, is it? So we want to leave you with this final thought. Can So-Young's rapid offline expansion mature fast enough to achieve overall long-term profitability before the staggering costs of brick-and-mortar overhead weigh them down? The unit economics are shouting yes, but that widening net loss reminds us that this massive transition is still very much underway. Thank you so much for joining us on this explainer, and we will catch you next time as we continue to decode the data.